Guys, let's take a look at the YM today. Look at this on today is the 21st of March. Hey, happy spring, everyone. So this is Friday, and you can see it looks all pink or magenta. It looks bad, bad, bad. Everything YM using the standard rule set with expected high low. Over the last 53 trades, you lost $12,000. But that's the standard rules. So the standard rules again are you buy at yesterday's low and you sell at yesterday's high level. Well, if you're paying attention to the market, you'll see that the highs and lows are being shattered quite frequently. And that's what expected high low tells you right here. It tells you that you don't want to follow the standard rules. You want to follow the exceptions or the alternative rules, I guess I should say, where you sell at the low. And you can see right here, we had a great sell opportunity. So at 8:42 in the morning, 8:42 is between here, 8:30 and 9 o'clock. There is a high probability that you are going to be closing below yesterday's low. So that's what we're seeing here. When we have a expectation of losing when you buy at yesterday's low, if you expect to lose it, that means we expect to go short instead of going long. And now if you go short, these numbers reverse, they become positives. So 8:30 to 9 o'clock, this is a positive 66.75, $6,700. And it did not disappoint today. Let me show you. We have already seen a big move to the downside. Now the average short is $376. So where is 376 on here? The average short, the average trade loses 376. So that is just 376 right to here. We've already been down to the downside, way down here at $1,400 move today. So the market is still selling off. Had you had expected high low on your charts at 8:30 this morning, this would have been the game plan. So very important to take a look at that. Guys, let's take a look at the NQ. Let's see if that's the same story. So the NQ, we got to get a little closer here, don't we? The NQ also had a breakdown, as you might have expected. But it is not as bad. It's showing that there is a strong move against these conventional or primary signals. Again, buying at the low. You get a average adverse excursion on the longs of $1,800, right? So what that means is on average, price moves through this level by $1,800. That's the adverse excursion. That's how far it goes against you. And let's see what we had on the move down here today. $2,600 before we started moving up. But let me also mention it is usually profitable. Yeah, it moves against us, but it usually reverts and becomes profitable. 8:45 in the morning. So when price hits yesterday's low at 8:45, we're in this green line right here at 8:30. It says if it hits yesterday's low at 8:30 to 9 o'clock, there's a really good chance, 50-50 chance, that we're going to close above yesterday's low. And we close above yesterday's low on a tune of about $8,000 profit. Just on, let's see, that is 14 trades. So 7 wins, 7 losses, and we close up about $8,000. And you can see right now we are moving to the upside, and that's exactly what expected high-low gave you as a prediction. Now this is a 5-minute chart. You can trade this on any chart time frame. What you want to do is you want to look for reversal bottoms, because expected high-low is telling you that this market, yeah, it moves against you, but it does move back. It moves against you, but it moves above yesterday's low, and it closes. We're expecting a close somewhere in the vicinity of, well, I mean, the average trade is $1,200 on the longs, and that's pretty good. So $1,200 going long at yesterday's low. $1,200 is expected right here, right about there. That's where we're expected to hit. We came actually pretty close to it. But you do need to think it would have been great to get down here. Again, since our expectation was the market closes above yesterday's low, well, these are good buying levels. These are good times to buy because you're planning on a move up into yesterday's low. One thing I would notice is a double bottom is put in here. Another thing is we have a good 1, 2, 3 pattern forming. Let's take a look at it 1 minute. There's a lot of movement here at 9:30, and that's going to be some good opportunity to buy this market. So here we go at 9:30. The market moves down, down, down. We see a move down, down, down. There is a let's draw my favorite triangles. I see a triangle right here. This is what I call an exhaustion triangle, where the prices had a new low. They had a weak high, but it was a weak high and then it failed and it pushed to a new low. So that push to a new low made this a strong high. This is a launching point for a new low. Now prices moved up into here. They moved up into this level. I'm just going to draw a horizontal line. So right at that point they moved up. That might be a good time to go long, right when it hit that level. And you can see we did take some heat. If you would have gone long there, you took heat down to here. So that's a $1,300 heat. Might be a little rich for you. But we did hit right away. We did get up to roughly 660 in profit. Now, putting a stop at that triangle's apex at the bottom is a great place to do it. Yeah, that might be a little beefy, a lot of risk for some people. The overall risk here is $1,400 in risk. But the point is, when we broke that high level, we basically changed the trend. We basically changed the trend direction. We brought a new high off of a new low. That was a big push. Market did not like getting down that low. And participants jumped in and started buying. They tried to test that low again. Interesting. They did not push to a new low. That's really significant. And trends start this way. This is how all uptrends start. There was no exception to it. A new low is formed, the low of the old downtrend. You push to a new high and you retest the lows. So if you're looking to do trend analysis, this is classic. This is a classic one. I'm going to draw another one here. Let's say, the markets it's no guarantee that we would have gone up from here, but it is something to think about that all trends start, I guess we can go here, with this pattern. All trends start with a rejection of lows and a push to new highs. So here's a little tighter spread or triangle exhaustion point. We're looking to go long in the direction of the middle apex. That's how I think about it. These triangles are pointing upwards. So it's a long signal. We had a little short-term low. We had a lower high. We had a new low based on that prior apex. And boom, we pushed a new high. If you're not eager to jump in, I don't blame you. But look at this. Once we did push above that apex high, right in this area, it did not push down again. So this is significant. We liked, the market tended to be happy above that apex high. So this now becomes support. So a patient trader is a smart trader, and a patient trader is a profitable trader. Yeah, you could have gotten in early like I've shown here. You could have bought right at this point on this bar at the move up at 931 right at the open. But there's no shame in waiting until this area right here where we do find a bottom being put in and confirmation. All right, guys, so that's a couple. There's more, but I'll let you go. It's been a pleasure, and I wish you all the best. God bless you. Email me or put a comment below. Subscribe. and we'll be happy to go over these things with you again. All right, thanks again. Bye-bye.